Good afternoon, everyone, and we warmly welcome you all to our earnings call for the quarter of Q3. So on the call today, we have our Group CEO, Kasturi Chelraja Wilson, and our Group CFO, Zalmi Fazil. And also we have on the call today, our Head of Group Sustainability and Corporate Communications, Ishani Ranasinghe. So in the interest of everyone joining for the first time, we will start with the macroeconomic update, followed by the strategic pillars, then moving on to the financial highlights. And we will then touch upon the business update, then move on to the ESG update, followed by Q&A. So moving on to the macroeconomic update. We did see that a surge in inflation where the CCPI and the NCPI denoted a growth of over 50%. Based on this, the consumers' purchasing power was to a certain extent hampered, and we did see certain volume contractions experienced, even in essential industries such as pharma. So a higher contraction was noted in non-essentials, primarily, for example, in Atlas, it was in color products, in pharmaceuticals, it was mostly related to vitamin category. We also saw that the consumers purchased smaller quantities frequently, and that there was a skewness towards affordable options, the discounts, promotions, or even to a certain extent to budget packs. Another notable factor was the overall year-on-year depreciation, which striked around over 80%. So Hemas, being a primary import-oriented organization, we were directly affected by the depreciation, directly hitting our cost of sales, as well as there was an indirect impact on the overheads as well. Moving on to global commodity prices, we did see towards the latter part of this particular quarter that the commodity prices did come down, but this was not directly translated into margins because of certain lag effects that were there and because of the depreciation I explained earlier. But we did see that this was more or less the price reductions took place in the early quarter of this year. In terms of interest rates, we did see there was a significant increase in the interest rates, and Zalmi will touch upon it on the financial update. Overall, also, tax reforms were undertaken during this particular quarter, with the corporate taxes moving on to 30%, which indirectly had a one-off effect on the deferred taxes as well. Also, there is commendable progress in terms of IMF, and the country as a whole is awaiting some positive response in moving forward. Moving on to our strategic pillars. So our strategic pillars have been the foundation upon which we have created value and being able to be resilient in this macroeconomic environment. If I touch upon the first pillar, which is building more from the core, we did, based on identifying various consumer needs and wants, the evolving needs and wants of consumers, we did add in new value for money options to our consumers. Especially to highlight, we did identify Komarika and Dandex refill packs, as well as Baby Sharani budget pack during the quarter. We also saw that the new revenue streams had contributed over 10% of the year-to-date revenue of the consumer Sri Lankan sector. We are also noting that there was Hemas had outperformed in several categories, namely toothbrushes, toothpaste, and sanitary napkins. More or less now moving on to Bangladesh, again, we did see that identifying consumer needs and wants, The Co-Marika Eniva had launched 150 ml variants, as well as that Actisep had launched 30-gram variants to provide comfort to the customers by providing affordable alternatives. The year-to-date revenue contribution from the new sector was over 20% of the revenue that is generated from Bangladesh. We are also happy to know that Atlas had traction and was able to maintain its market-leading position, especially in terms of pens and book category. In moving on to new within the core and adjacencies, Hemas did venture into the food industry with their recent launch of Tasty Country Flakers, which is a wholesome breakfast cereal made with 100% natural ingredients. Moving on to new business and internationalization, Hemas has noted an overall 60% growth in terms of year-on-year revenue growth for that 9-month period, and including exports touching upon a year-on-year growth of around 70%. Moving on to the efficiency and the productivity, there are lots of projects running in touching upon 5S, Kaizen and Lean initiatives, which has resulted in overall around 1 to 2% incremental effort to the margins. Zalmi will now take on the financial highlights.
Thank you, Hazel. So as you've probably seen from the results that we published on CSC for the third quarter and for the year-to-date, for the 9 months of this year, we have demonstrated very good, strong performance from our core, reporting healthy growth both in revenues and reflected the same in EBITDA, EBIT. However, the gains that we made at EBIT was, I would say, suppressed or compressed drastically due to high interest rates, high interest costs, and also the additional tax and deferred tax adjustments that we had to make in the third quarter. So overall, from a position of core businesses, we had strong growth, and we expect to see that strong growth continuing to drive the businesses going forward. We did see a sharp increase in debt levels. Again, that was primarily used to finance the working capital and also the additional growth in business from the perspective of the core businesses in the company. If you can go to, yeah. On the EPS walk, if you could see the graph on the top left-hand corner, where we showed that healthy operating profit growth of 4.53 compared to the benchmark of last year was more or less, leveled out when it came out from finance costs, which was a huge chunk. We saw approximately 85% of the finance cost being increased due to the rate increases in the rate, with 15% of the finance cost being generated, the increase being generated out from the growth in the business. Taxes had a small increase of about a rupee per share, and NCI was less than half, so driving our EPS to around this 5.38 mark. With regard to ROCE, we saw again the healthy improvement in terms of the group ROCE crossing the 22%. We were previously borderline close to the 20, which we then grew to 22, and we expect to maintain that level when we close the year in March this year. I think that's about it, and I would probably pass it on to Kasturi to cover the sectors.
Good afternoon, everyone. The format has changed somewhat, but I thought I'll focus purely on just giving you a flavor of sectors and how they focus and how they've performed. Particularly when I started consumer, this segment or this sector was the one which felt the biggest impact of the inflation in terms of not only cost, but in terms of consumer behavior. So overall, we did see between the learning and home and personal care, market contractions were anything ranging between 25 to 30. We did also have volume market, we saw that reflected in our volume contraction, but our volume contractions were way lower than the market contraction, which was reflected in where our shares were stronger and in most categories, except I think one where we did have supply chain issues. But where the focus, what I see is where our focus has been is making sure that our core brands retain their equity or grew their equity shares. We focused on making them more relevant for the consumer, be it in terms of value for money, in terms of affordability, or in terms of value proposition itself. And that's why we saw in the last quarter the innovations in the terms of what we bring to the table. The second aspect is we didn't defocus from the new, which was, if you recall, 2 years ago, we said that we will make sure we remain as a Sri Lankan company, bringing innovation which is relevant to the Sri Lankan consumer. As such, you did see that revenue from new overall has crossed 10%. And the other part of it is the innovation. What we did realize, and we continue, and you see while the new products categories of beauty getting traction, that was we launched last year and we've got significant traction on that. We saw the male grooming segment which we entered and revamped with focus, getting growth in volume as well as value share. And then the last one is Diva, which actually expanded its portfolio in terms of offerings to consumers. In spite of Diva being the category which really got impacted on supply chain disruptions, we still maintained and grew shares in most of it. So I think that shows that we remain strongly in HPC. In the learning segment, I must say, if you are looking at year on year, the third quarter normally in a standard year would have been the season starting from October, but this year around the season started only in December. So you would see the build-up of the season being towards the latter part of the quarter vis-a-vis the total quarter. However, what I see is that while competition was out there, from an industry perspective, Atlas still remained the leader in terms of relevance, and most importantly in terms of creativity and what was given as options to the consumer. So consumer businesses have been strong in all three angles, in innovation, in the new which they already launched, as well as the core. I'll touch base a bit on international. We see our international kind of growing while Bangladesh is a market which we are already present in. What really gives me pride is Kumarika was voted the #2 hair oil and most loved hair oil in Bangladesh. But I must say, as a category, hair oil seems to have contracted purely at the backdrop of the impact of inflation in Bangladesh. What we find is Kumarika is a premium product, but we took a call to hold it at premium because that's our positioning. However, we flanked it last year with a more affordable proposition, which was more on the beauty, and that we see has worked. That's why we see over 20% coming from the new products, which is the health soap, as well as the second category of hair oil. We will continue to invest in building the 2 new brands, as well as taking more of Hemas into Bangladesh. But the other markets which we focused on international, and I think today the international business is about 6% of total revenue, and this is in spite of the domestic revenue growing. Middle East seems to be getting traction, as well as Bangladesh, and there is some traction in Pakistan, but I'm mindful that these markets are also having their own challenge. But for now, the focus will be on the Gulf region and Bangladesh in terms of the other total international business. I'll just move on to health. So the healthcare sector normally is resilient, and it still relatively seems to be one of the stronger businesses in our portfolio. However, first time I think we did start seeing that while there's value contraction, we first saw volume contraction coming in the healthcare. It's just a small volume contraction, but still a single digit. But still, it gives us a sign of that the consumers are really having issues in terms of their affordability. But however, the businesses, while we saw a shift in terms of the non-essentials like the day-to-day vitamins and minerals reducing, we saw the NCD space and the RX side of the essentials, or what you call it, critical drugs, not growing, at least defending itself. But we saw purchase patterns changing. We saw frequency, smaller parcels, frequency, order time, order frequency is changing. So I guess there is a change there. Again, our core, because we are in terms of the size, in terms of pharma distribution, whether it's manufacturing or imports, the distribution network itself gives us the reach where when during crisis, we still keep it going. As such, we did see market share increase in both our businesses, manufacturing and imports in overall as pharma. But while the core was strong, what really was encouraging was the new in terms of the new own brands we put out under the brand of Morrison. And we've seen that we have only 2 brands which we have launched so far, right? 2 molecules. The others are getting approvals. I guess it'll take the turn in the queue, but which gives us quite a bit of encouragement and hope that these brands have actually a demand for it. They're performing way higher than what we actually expected as a outcome. On the hospitals, again, the core focus on getting into specialty centers of excellence has worked in terms, and IP revenue has contributed 54%, I think, of total revenue, which is an increase from where we were before. I guess that the mix change, because remember, our hospitals are also, because we sit not in the city and on the periphery of the city, we kind of have not felt the volume drop as such. So while we will battle with making healthcare affordable, we also have to be able to have answers to the ever escalating cost of operations within the businesses. Lab chain, which is hitting around 50 plus labs, also had a good quarter with increased month on month, year on year in terms of volumes and values. Basically, that's there on the healthcare. I'll take questions on it if you need later. On the mobility side of it, we have aviation. It's now it's only aviation and maritime. We saw the demand for space, unlike last year, for cargo contracting. That's a reflection of our exports seeing contraction as a country, and global consumption coming down in those products. But what we saw as a positive is that Emirates increased their frequency from December, and as they speak, they are looking at increasing it further. So the passenger sales kind of improved vis-a-vis the cargo. However, what worries is on the maritime side of it, Sri Lanka as a port is having its own challenges. While globally there is contraction in consumption, as a port, I think the multiple issues in terms of disruption seem to actually see Sri Lanka losing its stronghold as a hub, as a transshipment hub. So at the moment, we've seen Evergreen still defending its share. We hope Sri Lanka would really focus and get its place in the Southeast Asian maritime lane as a hub. But for this quarter, our numbers, our volumes, while it was contracting, our values were growth in terms of revenue and EBITDA is quite significant. Basically, those are my key things on healthcare. You might have some questions on the Homagama plant. We have started commercial production and we sell off the plant there. Currently, we operate around 10% in terms of capacity utilization. The highest has been 10% 1 month. But remember, this is on the backdrop of we still are not getting the buyback, which was signed to us in 2015, 90, and then renewed in 19. That seems to be still under all sorts of different, I don't know, vested places. But we are moving along in spite of that, and we're not putting too much of emphasis on the buyback now. It might be a good thing also with given the debt profile in terms of government. But yeah, so that's the Homagama update. And overall, as a business, I think while we are very strong in terms of core, we are strong in the new stuff we're driving, and the fundamentals of the business is strong. We did see overall as a group, our working capital getting expanded from few things, which is the devaluation of the rupee made us need more rupees. Secondly, that Sri Lanka, especially in the third quarter, we saw the highest impact in Sri Lanka. When we operate with LCs from Sri Lanka, it's not respected. So you kind of move to different instruments like cash margins upfront. So you change the way the working capital cycle works. However, as I see now, in this fourth quarter, we see some reversal of that. But that whole operation, the challenges we faced didn't help us in terms of our interest costs in total. So which is why you see our earnings being flat. It's predominantly and only driven by the interest rate and the whole size of the working capital we operate on. Yes, and I think the ESG, I'll get Ishani, who heads sustainability for the group, to take on the ESG agenda.
Thank you, Kasri. Good afternoon, everyone. So during the quarter, we continued our efforts to minimize the environmental impact. So the two big initiatives or two key initiatives we focused on for this quarter is we looked at offsetting our electricity consumption by moving into roof-mounted solar panels, and these were mounted in all our locations with significant operations, and we will be fully commissioned by June. And we also extended our partnership with Clean Ocean Force, and we took on we adopted the Preetipura beach, and to date we have 9 locations where over 27,000 kilograms of plastic is being collected. While we looked at the environment, we also looked at the society as a whole, and our focus was how to eliminate inequality and create a social security net. So Hemas, we always do long-term and impactful projects as opposed to doing one-off projects. So on your screen right now is some updates on some of our key projects for the quarter. So we celebrated World Diabetes Day through our Say Yes to Life Purpose campaign, where we carried out 5,000 free testing to our internal and external stakeholders. Then which a project that FEMS is doing, we tackle period poverty. And during the quarter, we created awareness to about 2,000 plus women, and Baby Sharami, one of our flagship brands. We carried out parental clinics to over 4,500 families. Then Hemas Group has in place a ESG management framework, and every quarter we monitor our performance, which is then updated to the Board of Management. And on your screen is a snapshot of our quarterly performance. Thank you.
Thank you, Ishani. Now, Kasri will please take us through the focus areas for the short term and the mid and long term.
So the short term is like what we've been focusing on in the last 1 year, given the crisis, and we don't see this easing up for the next 12 months, would be making sure we defend and grow our share. And there would be absolute teams are aligned to make sure our core business and our brands actually continue to grow in share. We've seen right across our businesses, whether healthcare or consumer businesses, our brands have been strong, but most importantly, that we have been growing share. So that will continue. We will continue to look at our innovation and develop products which are relevant for consumers and the future needs, which means it will not take the foot off the pedal in terms of growth. That would be a big part of it. International, if you were there last year on some of my calls, I kept saying international and Bangladesh. Yes, the base is small, but we will continue to put focus and resources behind that. So it will be both international as well as Bangladesh as a country to focus on doing more there. But from a working capital side of it, liquidity and keeping cash will be priority. So we will be ramping up our efforts in terms of collections, in terms of restructuring some of our debt. And then from a cost perspective, you could see that as a group, we had improved, our OP had grown high, OP margin had grown higher than the revenue growth, but that gets lost in terms of, and that came from actually most importantly from initiatives we have done right across the group on lean and restructuring of certain costs. This will continue. We'll be looking at how we can really structure ourselves in terms of that we're efficient, most importantly, in terms of making us nimble, which dives down to the last one. We'll be focusing on our talent. Today's context, retaining talent and attracting talent is tough. But in that context, whoever we attract or we retain and we have it in the group, we need to figure out a way of making it easy for them to operate in and making it simpler. So that is one part of it I feel is we need to look at this year, which we would do in terms of shaving off complexity as well as cost. Mid to long term would be, we continue to look at certain interesting acquisitions which will come our way. It will be based on a bolt-on if it is close to our core, from value addition point of view. From a learning space, we are looking at it and piloting some of the new adjacencies. Hopefully that will be looked at in interest in the medium term. In the short and medium term, Morrison would be the one key thing. Remember, building our own brand of generics. Once you build that for a couple of years and you show success in a local market, only at that point can you take that as an exportable product, because you need credibility within local market for you to go and export from a pharma perspective. We are also looking at, while I looked at Bangladesh and Middle East as markets we have tested and we found that we have really success, and we invest more in the mid to long term. We need to identify at least 1 or 2 markets which we're exploring at the moment. So basically our short-term cost saving, doing what we do well, protecting and growing our core, as well as investing for the future, making sure we are relevant and Sri Lankan consumers get the best of what we can offer. So basically that's it, and cash is king. So those are my 2 short and medium term focuses. I'll leave it up to you, I think, to open it up for questions now.
So Kasturi, we've received one question at the moment. The question is, what's the plan on the pharma plant utilization?
Yeah, so I'll answer it this way. Yes, pharma plant utilization is an important part of it. Also, the revenue mix yield in terms of where you utilize, what you bring into the plant is the second thing. So how we plan it from where we are today and the type of product pipeline we've got in the system, as well as markets, categories we are chasing behind those innovations. We feel that we're at about 33 to 35% of capacity utilization, we break even at pharma. But today we are at 10%. So towards the end of the year, we plan to ramp up to the 30s. Hopefully with if the NMRA gives our registrations on time and if we launch it on time.
We've received another question in terms of HPC. It reads, the HPC international segment seems to be losing market penetration in the urban households while the rural market penetration is increasing. Is there any particular reason for that?
Yeah, that's a good pickup. So if you see our products, Kumarica, the oil actually goes as a premium hair oil. We have seen some downgrades from Kumarica hair oil into other options, which you see as a pickup there. However, what we've done is we've also morphed it into getting some smaller pack sizes, and I'm hoping that works. But what you see as a pickup in the rural is we've given the new products we launched last year or year before were actually how we launched it is we came outside in. We started from rural because that was a product offering for value for money segment. And then we moved it into the urban. So at the moment, that's picking traction. But on equity side, if you really do go out and see, and Bangladesh as a market, the grocer or the general trade has just X number of taka, right? And they spend 70% of their money on food essentials. And out of the what they put as non-essentials, our products get picked up all the time. So there is equity there. But what we need to be mindful is a premium product during this kind of the economic or the pressures the consumer is feeling due to inflation in Bangladesh is impacting our premium brand. And we are quite aware of it. We took a call of holding that differential price point and holding its position, but we are flanking it with other options, which would be catering to the downgrade. Yeah.
Thank you, Kasturi. So Asanka will now pose a question. Hi, Asanka.
Asanka, are you speaking or we can't hear you? Is that...
Hi guys, can you hear me now?
Yes.
Thanks, Kasturi, Salmi and the team for the call. A couple of quick questions from me. If you look at the volume momentum on the local FMCG side, we had a couple of cost of living shocks around September, October in terms of electricity hikes, etc. What are you seeing in terms of the volume evolution in October, November, December, and maybe January? Is one question. And secondly, are you seeing any kind of movement in your volume mix, which is material? Those are the two questions.
So the first question, for the second question on the volume mix, I didn't see anything material, so I'm not sure I'll let Teresa answer. But the first question, yeah, you did see the shocks. That's why you see the market contraction actually happening there. First market contraction would have been supply chain disruptions during the first quarter last year. Then we ended up seeing the market contraction continuing. What we see is that they are downgrading to pack sizes or they are downgrading to value for money kind of brands, which is simple, functional, which we've offered as well. We see that in every category, but only place we are still to see this work impacted too much is baby, because I guess the fact that baby Sherami is we claim we are safe for baby and we don't compromise on that. It's kind of holding its own. However, we see for all other categories, the downgrading or onto value for money pack sizes or a functional proposition is happening. So you see that impact of inflation throughout. So we haven't, that is up to December, Sangha. So I wouldn't know to tell you, I have the market reads that come in. I don't see it worsening, but I think what you see the next few months would be figure out with what happens for the next few months. On the mix, I don't see a big shift. We don't.
Thanks a lot, Kasturi. Can I go ahead with one more question, please?
Yes.
Sure. Zalmi, in terms of working capital requirement, are you seeing an improvement in the situation starting from what you witnessed around August, September to now? And secondly, I think as we speak, the benchmark AWPLR has come down about 300-400 basis points since about 6 weeks ago. Are you seeing any kind of improvement at the your working capital financing costs?
Yeah, I mean, for both those questions, actually, Asanka, it's yes. So we've seen a gradual shift from the banks where until about August, September, they were not willing to open LCs on deferred terms, even though our suppliers were willing to give us that. For example, we had very good supply terms where we had 120, sometimes even 180 days credit on LC. But because of the restrictions in the current situation in the country, we were not able to exploit that credit period, and instead we were forced to get our supplies either at site or sometimes even on advance payment terms. That has shifted to a good extent, not to the levels that we like, but we are still starting to see the 60 and probably. Hopefully in the near future, we'll start seeing the 90 days as well. On the borrowing costs, yes, we did see the rates, quoted on short-term borrowings at the plus 30% levels at the beginning of the quarter and the end of the second quarter. We have started seeing the rates going down. In fact, there is a question where somebody has asked what the current borrowing rates are. We are hovering around the mid-20s, and we probably will see that going down even further over the coming weeks. But again, fingers crossed and hope that we don't see any, sudden shakes in the market. But hopefully, cautious optimism in the way forward is what I would see at this stage.
Thank you, guys. Thank you very much.
So thanks, Armi. So Naveen Gunawardana also likes to pose us a question. Hi, Naveen.
Hi, can you hear me?
Yes, we can.
Kasturi, Zilmi and the team, thank you very much for the call and for the presentation. And congratulations on some good results under very challenging conditions. I have two questions. One is, you all appear to have held margins, particularly in the consumer space. Do you think that you'll be able to defend margins going forward? That's the first question. And the second question is that, were you able to defend margins simply because the margins on some of the, how shall I put it, the lower volume products are better?
Naveen, the first thing is, I think when we had the beginning of the year, when we had constraining effects, we actually took a call of rationalizing our portfolio on the low volume products. So technically, whatever we focused on was brands which mattered, which had significant share, and we wanted to make sure we held equity there. Having said that, margin pressure was retained. So we went to a cycle through high commodity prices, then we had taxes on top of it. But what we did was, whenever we saw commodity prices coming down towards something in October or sometime in October, we started reducing prices as well. So we had a pricing philosophy which we were not going to waver from, so that we made sure that the consumer got the benefit of whatever we got on excess on top of it. So as we stand, we have given some reductions and relief to the consumer. But going forward, the indications are that the commodity prices will come down further. But we are still to see the impact of our input costs in terms of local inputs, the electricity input and the local purchases, which would have indirect cost increases due to things like electricity or fuel. We haven't seen that impact, and based on that, we would see, and if global prices come down, we'll stick to our pricing philosophy. Does that answer your question?
Yeah, thank you. The second question is on the balance sheet. Your long-term borrowings appear to have gone up. Could you care to comment on that?
So in the long term, it's just a notional accounting adjustment for a lease adjustment. But otherwise, the long-term debt per se, bank debt remains flat.
Thank you.
Thank you, Naveen. So Michael also has a question to pose for us. Hi, Michael.
Hi, can you hear me now?
Yes, we can.
Thank you for taking my question. I work for a company called Research Alpha. We are a new investor in your company. I've been reading about the reforms in Sri Lanka over the last several months. Have there been any reforms that would benefit or hinder your company?
Hi, Michael, and great to know that you're an investor with us now. And so Hemas, as you know, is a consumer and healthcare group, and traditionally, from 2016, healthcare has been, especially pharmaceuticals, has been under a price control regime, which means that most essential drugs, which constitute about 55% of the market, is under price control. So I think where we would, if there is any reform there, and I hope there is now, is that the government comes up with a mechanism which actually reflects the key cost drivers of a pricing. Where what I mean by that is when they brought price control, they didn't bring a mechanism. Up to now, we don't have a mechanism. However, the only biggest delta we would see is when the exchange, because the dollar was, when it appreciated, we hit to see a huge swing, and that impacts the price in full. So that was the only element they included in any deviation and price adjustment. In today's context, it has changed. So if there is a reform and they look at pricing again as a whole, because anyway we are controlled, and look at elements like interest, in elements like electricity, and bring that and inflation into the formula, that would be a benefit for us in terms of our margin, because at the moment we're operating without that. On consumer, the businesses are not price controlled. Having said that, Consumer Affairs is mindful and working with businesses to make sure there's fair pricing, especially in the stationery segment. And Hemas, as a philosophy, we make sure our pricing philosophy is consistent. We make sure that if there is a influx, or if the increase in terms of paper prices up or down, that reflection is passed on to the consumer in a consistent manner. So we don't see an issue on that side of it, but we'll see an upside if the government actually looks at something as a policy there.
Okay, if I can just ask a follow-up question on that. Has the reform in pricing in pharmaceuticals already taken place so that's inflation adjusted, or is that just being proposed? And then secondly, I've heard that one reason that Sri Lanka doesn't have convenience stores is that all the prices have to be set at the factory rather than at the point of sale. And I was wondering that if there's going to be any reform to that situation.
Okay. The first one is, of course, price control, as I said, came in 2016, and the last price adjustment we got from the government on the price control items was I think in July or August last year, 2022. So there hasn't been any adjustment after that, and I think there should be an adjustment to the prices maybe by April. There is a standard 6 months process, I think. So that's the first question. The second question was, Michael, sorry, you had a number two.
It's a little bit off topic, but as I understand it, there's prices have to be determined at the factory rather than at the point of sale. And so you can't have 7-Eleven convenience stores in Sri Lanka.
So Michael, I too, so I also handled pharma maybe 5 years ago, and I was curious where it came from. It comes from an act on consumer affairs where they actually need the pricing done under some supervision. And then control on the value chain. The manufacturer has to take ownership on that. So hence we do it under the at the manufacturing point. But having said that, in pharma, because it's essential and you store a bit more towards the closer to the consumer, that gets a special approval if you do pricing in terms of labeling, stickering in a place which is not at your factory. You have to have special approval and supervision. So it makes a big, that's a bit costlier. So you roll back to the factory which you control and get it done in kind of in a more efficient manner.
Mm-hmm. Is there any moves to reform any of these, to improve the price reform or to reform pricing in Sri Lanka? Or is that not being included in the reforms the government's rolling out?
At the moment, the reform, what they're pushing is simplified pricing. That's been pushed as a reform. I think they've gone through that quite a bit by taking off control, price control in a lot of items. In terms of, we were controlled in terms of fuel, in milk, in lots of categories. Only thing standing tall or remaining is pharma. But most there is a plan of reforms. But honestly, if you ask me, will that be top of agenda at the moment? I wouldn't think so.
Unlikely.
Yeah.
Okay, unlikely. Okay. Thank you very much for answering my questions, and congratulations on the good quarter.
Thanks,
Thank
Thank you, Michael. Kasturi, we have one more question. In terms of HPC Sri Lanka being a supplier at a lower price point, does HHL plan to expand its distribution network in the short term in order to grow their volumes, or more or less is the strategy to increase the volume from the current network?
So I think what I think we've done is, if you look at it, I'm not sure if you have followed, we don't give the data, but our distribution network has a target of growing every month. So what the shops we reached last year and shops we reached this year, two different numbers. So any distribution business, if you are growing share, you grow share in that within a locality as well as you go wide. So both strategies are there. For that, it's the equity, and with you need to have a distribution network. So that is part of what we do. We don't say we are going to be curtailing ourselves to this, but it has to make sense in terms of a cost to serve. So that's where we will look at.
We've also received one more question. It says, has there been price reductions in HPC Sri Lanka to cope up with tax and inflationary pressure?
So the first question, I'll break it into two. The price reduction is purely because we've seen a benefit we got from procurement of global pricing. Tax and inflationary pressures even add to our cost. So technically that should drive our price up, but what we did was we did set it off against any benefit we had, and we gave a net benefit back to the consumer.
Two more questions, Kasturi, for you. Are you seeing any acquisition opportunities?
I think the market is seeing acquisition opportunities right around. We've seen some as well. Yeah.
And there's one more question which reads, tell us more about your learning platform and that business.
So I'll tell you one thing is it was by accident because during COVID, Atlas controlling about 65% of the market share had to do something to engage the students who are our customers, and that's how we went into a platform and got the best teachers to kind of take classes for the grade 5. We targeted grade 5 scholarships as a particularly segment because we do our purpose efforts around the kids. We give scholarship, and we've given over 2,000 kids those scholarships. And one thing which I realized a couple of weeks ago was one student who came, number 2 in the island was a student who came on our platform during last year. So it started with that. And then we thought, okay, you have this ecosystem. How can we give access of best teachers into and access to these students who are in very under or in communities or in villages where they don't have access to these kind of quality teachers. And we started toying with that. We have a free platform and we have a paid platform as well. We see the conversions at the moment, it's pilot. We see the conversions kind of going at about 8%, which seems to be higher than a norm. I'm not sure. I thought that was low, but that apparently on the digital business, it's higher than the norm. So that's our experience. Now we are looking at how do we take it to the next level, and hopefully we'll have some traction on that when I meet you next time.
Thank you, Kasri. So Zalmi, there's one question for you. It reads, what are you doing to reduce your tax expense?
That's a tough one, really, because we've seen the government actually increasing tax rates. We saw the benefits that we got at 24%, now moving back to 30%. And we are looking at a lot of opportunities where we could optimize, I would say, rather than reduce, but optimize our tax expense in a way that would actually be beneficial for the group. We're looking at lots of alternatives, and we probably will start seeing those results coming out in the coming years, probably FY24, FY25.
Thank you, Zalmi. Kasri, there's a question on Tasty Country. When was the Tasty Country segment introduced, and is there any further food-related products the company is planning to introduce? Also, how has been the traction on this product?
So our entry here, or our test entry here, was because we were not playing in the big category of food, but when we chose to enter, we just chose on a healthier platform, because health being a core part of what we stand for. So the fundamentals of this product was using functional Sri Lankan rice and creating products which are ready to eat and give an alternate which is healthy, and no, it's all natural. We launched it in Feb or December end, and we did a control launch in modern trade of in Colombo, in a couple of chains. For now, we see decent traction, but where we need to sort out is when you get into food, I think the challenges the team is working on is getting the production to deliver as per the demand you have and getting supply chain. The question you all had on, do we go into other food areas? As long as it's healthy and it stands for what's good for the consumer, that would be a category we look at. It is come with the basic and variants on this cereal format, and it's an interesting product which I kind of have got used to, but and let's see how it goes. I mean, today we have headwind because there is import restriction, but we need the product to stand on its own as a product which has exportable kind of equity as well. So for now, it is, we see traction is there, but it's too early for me to say anything more on that.
We have also received one question. It reads, what is the contribution to top line and EBIT from each segment? Since it's already provided in the quarterly financials in the segmental information, we will not take that question at this particular forum. Before we close, I think Asanka has another follow-up question for you, Kasri. Hi, Asanka.
Hi, guys. Sorry to trouble you again. Kasuri, I have one last question from me, and this may be tough one for you to answer, but anything you can share is useful. I mean, you just reported historically highest quarterly EBIT, and it seems as if consider staples as a category, and obviously healthcare as a defensive business is doing well. Any kind of thoughts you can share on the overall earnings momentum of the company will be appreciated. Going forward, that is.
I'll get Zalmi to talk on that.
That's a smart one, Kastur. Asanka, so as you've probably seen from the numbers in the third quarter, the momentum is there. And like I said earlier, what we don't see any issue or any, I would say, roadblocks on the way forward, speaking very cautiously, provided the situation in the country remains the same or improves. At this stage, I don't think we would see any kind of unrest like we saw, for example, in May last year, which led to the events that we saw in the change in the government and stuff like that. If we see stability remaining in the country and, you know, this cautious small steps that we are taking in the way forward, I would see that Hemas would be, you know, being in the segments that we play in, we would see the momentum going forward.
Asanka, one thing I want to add is, remember that Atlas didn't have its season in, it started its season in the last month of the quarter. So this quarter would see a full season of it, or this January, February would be as Atlas stationary season.
So yeah, as Kasturi mentioned, so I think we are looking towards closing the year with, you know, with all the pressure that we've had from interest rates, from taxation, from higher working capital requirements, all that still clubbed together, we should see Hemas doing cautiously, I would say, well.
So I would answer it this way, saying that while financially he's cautiously well, I'll go back only to the fundamentals of the business. If our core is strong, if our new is getting traction, and we are focusing on making sure that those grow, leaving international aside, I think you are looking at a cautiously okay or quarter.
We should close the year decently, I would say that. You know, I would be very cautious there.
Asaka, that was a loaded question, that's right.
Yeah. I think that's it.
Okay. Thanks, Asanka. So thank you everyone once again for joining the call, and we all wish you a very pleasant second half of the day. Thank you.
Thanks everyone. Bye.